The Department of Finance launched a consultation into the R&D tax credit earlier this year, and we're still awaiting the outcome of that. Submissions closed in May, and we submitted our own response to the Department of Finance at that point in time. We expect that the budget later this month will be framed in the context of that review and the submissions that the Department of Finance have received. Our own submission, we interviewed and surveyed a lot of our clients, and there were some interesting findings that came out of that. Perhaps the most interesting finding for us is that the importance of the R&D tax credit was really highlighted by the fact that 50% of multinationals said that in the absence of the tax credit, more than 2/3 of the R&D work that they do here in Ireland would move abroad. On a more positive note, 80% of those that replied to our survey said that if the R&D tax credit rate was increased to 35%, they would undertake more R&D work in Ireland. And more than 90% said that if there was a specific green tech credit of 50%, that they would do more R&D work here in Ireland. For SMEs, and not surprisingly, cash is important for SMEs. The most attractive feature of our R&D regime was considered to be the cashback, and currently that is paid out in 3 instalments over a 3-year period. Given where corporation tax receipts are at the moment, I think that accelerating those refunds to the first year shouldn't be that onerous on the economy. The environment for R&D in Ireland is still positive, but can be a bit mixed depending on what sector you're in. Tech companies, as we know, have been under pressure this year, pressure arising after COVID, pressure rising from supply chain shortages, chip shortages, and interest rates rising. So those pressures that they're facing has led them to reprioritise which R&D projects they may look to invest in. That has a knock-on impact then on hiring decisions, and we've seen a bit of a slowdown in hiring in the tech space. What that means for those companies in the short term, they will adapt and they will change. But longer term, we may see them really focusing on key strategic areas, and that broad approach they've taken to R&D may be more honed in now on specific areas. Life sciences, I suppose, is another area that is doing really well at the moment. We continue to see investment into Ireland, and only in recent weeks we've seen announcements of large capital investment projects outside of Dublin. Those projects are supported by IDA grant funding and will also be underpinned by the R&D tax credit in due course. And that funding can always and often act as a tipping point as to whether projects are brought into Ireland or go elsewhere. While the funding in itself may not be material in the overall context of what they're spending, the fact that Ireland Inc. is supporting and backing those projects really resonates with the decision makers abroad. In a more general context, what we are seeing now that Ireland is almost at full employment is that the availability of skills and hiring in certain key areas is becoming more difficult. The shortage of talent where companies are looking to grow and expand, particularly in key R&D areas, is something that could slow down the pace of technological advancement in Ireland as we look into the next couple of years. Having considered the consultation earlier this year and the submissions that they would have received, the Department of Finance now have a unique opportunity to improve the R&D tax credit in Ireland and to really ensure that the tax credit going forward continues to be best in class and continues to attract R&D investment into Ireland, as well as maintaining what we have already. The most important tweak that we need to see in the budget from an R&D tax credit perspective is that the tax credit is seen as a qualified refundable tax credit from an international perspective, so that when our multinational companies are looking at Ireland, and particularly the US multinationals, that the tax credit is fully considered to be a qualified refundable tax credit. This will ensure that the tax credit continues to be relevant for those companies when looking at Ireland as a destination for R&D, that it will continue to form part of their decision making as it will have real value for them. In addition to that, in the context of the implementation of BEPS Pillar 2, we feel that the R&D tax credit needs to increase to at least 30% to have the same value pre and post implementation of BEPS Pillar 2. If we don't increase the rate of the tax credit, then for farm companies, for farm multinationals that are in scope of BEPS Pillar 2, the actual value of the tax credit is going to be less.